I've spent months studying over 100 millionaire portfolios, from business owners to investors, to understand how they really operate. And what shocked me the most is they don't chase trends and they don't follow the crowd. They actually do something that's most different to anybody else. And there's many reasons why I decided to have a look at these portfolios. And this includes things such as general curiosity, learning different patterns and learning what works to actually really understand how I can implement what they do into my own personal life. And by watching this video, hopefully you'll be able to do the same. And today in this video, I'm going to be breaking down how they actually invest, how they break down the money, and also how you can apply this to your life without having a huge income and if you've got minimal savings. Section 1 of this is going to be looking at the mindset, because most millionaires think about the long term rather than the short term strategies. And the key idea here is that they don't think about get rich quick schemes. They think about the long term and how they can build their wealth over decades, not days. And how they do this is that they focus on time in the market rather than timing in the market. So it's really important that they generally will invest whenever they see fit. And it's not necessarily about being at the right place at the right time. It's about being in the market long enough to be able to make your money work for you. And this can be as simple as investing in the stock market. The longer you're in it, the more of an effect that compound interest will actually have on your money, and therefore the greater wealth that you'll get, rather than buying in stocks and shares and selling within a week and hoping that you've made £5. And by looking at things such as compound interest, you start to think about how does the money work for you, and how does it work for you whilst you're doing other things such as sleeping or seeing your friends. And if you can make your money do that and it can work for you whilst you're doing other things, that's the real key success to actually getting wealthy. What they also do is they actually avoid emotional investments. So doing things because they feel emotionally attached to the money, they genuinely will invest money that they can prepare to lose. And because of that, they can think more strategically about it rather than being emotionally invested in the project. And wealth is generally built from consistency. A lot of people think that they need to have some crazy idea, but actually performing the same task multiple times and being consistent within the market actually genuinely wins overall. And what you'll also realise is that it'll prioritise financial independence rather than appearance and status. A lot of the millionaires and billionaires that are actually in the UK and globally, you probably have never heard of, and because of that, that's how they've got wealthy, by staying quiet and focusing on what works. And the question that they ask themselves is not what will get me rich tomorrow, it's what will get me rich in 5 years, in 10 years, and in 20 years' time. Section 2 is looking at diversification, which is actually one of the core principles of any portfolio. And that's because no millionaire has just one type of asset class. They don't just invest in property, they don't just invest in the stock market, they don't just hold cash in the bank or invest in certain companies. They have a range and not just one. A common mix that I've been seeing is that they'll have 40 to 50% in stocks, 20 to 30% in property, and 10 to 20% in business ventures. And diversification is so important because it protects against the volatility. For example, your stocks and shares might be doing really well, but your property might be doing really bad. And the idea is that they offset each other so that hopefully your portfolio will grow over time, or at worst case, at least you break even and you don't lose any money. So millionaires will often play offensive and defensive, and this is generally where you're being offensive on one side, so you're investing hard and you're more risky, but you're defensive on something that's less risky, and the idea of that is that you can balance off your portfolios over the long term. And the idea of that is that someone with stocks and property, they can weather downturns in things such as property markets falling, if stocks are hopefully doing really well, and vice versa. So section 3 is actually looking at multiple income streams. Most millionaires will never have one single income stream, and you might have one at the moment, and that might just be your full-time job that you do and you earn a paycheck at the end of the month. But most millionaires will have multiple income streams through dividends, through property, through maybe a salary, business and ventures, and dividends as well. And this will range from between anywhere from 3 up to 10 different sources of income streams. And both active and passive income is both really important. So active income is things where you're actually working for your money. So it might be that you're working a full-time job. It might be that you're investing in a business and you've worked partly for that business and you're getting a dividend from that business. Passive income is generally where you're not trading time for money. So because of that, it might be things such as you're investing in the stock market and you're getting dividends. It might be cash in the bank and you're getting interest on that cash. And it's the passive income that generates the long-term wealth. If you can get to a point where you're not trading time for money, that's the real key, because you can save your way to wealth over long term, but what you do need to do is have your assets earning for you whilst you're sleeping. And what I'd really encourage you to do is work on building one extra income stream to start with. So you may just have your full-time job, but try investing a little bit in the stock market, or maybe you'll have a little bit in crypto that you're prepared to lose, or it might be that you've got some money in the bank that you shift around to make sure you're getting the best interest rate, which pays you a good interest at the end of the month. So work out how you can get one additional income stream this month, and that will really change your perspective of how you think about money. Section 4 is looking at cash and liquidity strategies. The idea here is that you want to keep enough liquidity, which is i.e. free cash, available cash that you can withdraw at any point, for safety, but you don't need more than you need, because that could be going somewhere else which could grow more than it would get by sitting in the bank. I've already said in previous videos that I think you need a 3 to 6 month emergency fund in cash available should anything go wrong. Anything above that, I think you should be investing somewhere else. Mainly people will be investing in the stock market and in index funds, and the idea of that is that that should grow at anywhere between 5 to 8% annually, hopefully over the long term, and that will grow and compound over time to a point where you'll hopefully have got millions in the bank for a smaller amount than you've invested. And you should be using the excess cash for other ventures. So it might be that you've got enough for deposit to buy a rental property. You might want to do a little buy to let, which will get you rental income, and that property will also grow in value over the long term. It might be that you want to invest in stocks and shares. It might be that you want to invest in your friend's business that will hopefully go well. So think about how you can use that excess cash over and above your 3 to 6 month buffer to make sure it's working for you. Just making sure you've got that safety net available should anything else happen, and then you're launching your funds into new projects that will hopefully generate more income than it would do by sitting in the bank. And remember that money that sits in the bank actually loses value, because whilst you may get a 1 or 2% interest rate every single month, what you'll actually find is that inflation is at 4 or 5%. So every pound that you have got this year, it'll buy you less next year. Section 5 is looking at risk management and education. What you'll find, and what I found by researching these portfolios, is that millionaires don't take risks, they take calculated risks. And that's really important to understand, because what they'll do is they'll be very methodical in how they understand the risk and the risk of their money by investing. But what they make sure they do is that they're protected should anything go wrong as much as they possibly can. They only invest what they understand and what they think that the projects can do with their money, in order to be able to minimize their potential losses. They'll try and diversify their portfolio into new markets that may be outside of their current knowledge base, but generally what they'll try and do is at least have some basic knowledge of the market, because that will really help them to steer that project and understand if things are going south. So for example, if you're investing in a property business, but you've got no understanding of property, how the property market works and what the latest trends are, you're going to really struggle to be able to use your knowledge to be able to help drive that business forward if they need your advice, and understand when perhaps the business is going south that you may need to withdraw your investment. Whereas if you had some knowledge of the property market, that will really actually help you to understand those potential risks, and therefore it's more calculated. Remember, you can continuously learn this. You can use books, mentors, online digital assets and platforms, and educational platforms that will actually be able to help you learn some of the basics before you dive into an investment. So you may be able to still diversify your portfolio and go outside of your current knowledge base, but make sure you're learning at the same time to be able to catch up on that missed knowledge. And remember, rule number 1 is to try and protect your capital first before you're investing a lot of money there. And section 6 is going to be looking at habits and behaviours, which is arguably one of the most important factors in this video, because it really dictates how people think about investing rather than actually just doing it. Because wealth is more about discipline and the consistency of it rather than just being pure luck. And what you'll find is that the wealthy millionaires will consistently invest at regular intervals rather than just doing one-off investments. And how you can implement this into your life is by automatically investing every single month. So you can invest on platforms such as Trading 212, and you can set up direct debits to take money from your bank. It will upload it into your portfolio and automatically invest that for you. So you haven't even got to think about it. So this is the idea of automatically investing and investing consistently on a regular basis, and that is what will generate long-term growth in your funds. One of the other things is actually delayed gratification. Most people want get-rich-quick schemes. They want to invest now and be rich tomorrow. However, that just doesn't happen nowadays. So what's really important is that you're investing your money, and whilst you think, oh, I've got a lot of money sat in that portfolio, you're doing it for the long term. So you may need to cut back on some of the luxuries in your life in order to be able to invest. But actually, in 5, 10, 15, 20 years down the line, I'm sure that you'll be grateful that you did that, because you need to be in it for the long game. I would also take regular portfolio reviews, so making sure you're looking at how balanced your portfolio is, because as portfolios grow, they may become weighted. So you may invest 50% into one and 50% into another initially, but one may grow more or grow faster than the other. So actually what happens is your weighting of your portfolio changes. So you might then actually have 60% in one fund and 40% in the other. Just really make sure you're taking portfolio reviews, looking at should you rebalance those portfolios, or should you invest some of that growth into a new fund to be able to further diversify your portfolio? And try and have low emotional investing. You don't want to invest in Apple because you like the new iPhone. You should be investing in Apple because you think they've got good products that will grow over the long term. You think there's still a good hype around the products, and every time they release new products and new software, that they'll be able to release more, they will make more money, and hopefully that portfolio will grow. So it's really important that you're thinking about what is the business actually doing when you're investing? How is it aligning with my own values? And how do you think it will grow over the long term, not just this year? So remember, wealth isn't about luck, it's about structure, consistency, and familiarity. So it's really important that you follow those key steps, and hopefully this video has been found useful for you.